This podcast was recorded on the date indicated with the link. The views and opinions expressed herein are as of the date recorded and should not be construed as an offer to buy or sell any securities. Such views and opinions may differ from those of DoubleLine Capital or its affiliates and are subject to change without notice. DoubleLine has no obligation to provide updates or changes.
Welcome, folks. This is Jeff Benjamin and the Investment News Podcast. I'm here with my colleague and co-host, Bruce Kelly.
Holy smokes. Is that Jeff Benjamin I hear?
It is. It is Jeff Benjamin.
I can't believe it. We're back on a podcast together, man.
Yeah, we were separated for a few weeks of vacations and stuff like that.
We were like ships in the night. We kept missing each other.
But we're back. We're back.
I was very depressed, Jeff, about the whole thing.
Well, this will make you feel better, Bruce, because this is going to be a warm and comfortable. We're recording this as our first episode of the new year, even though we are recording.
And Happy New Year, Professor Benjamin.
Happy New Year, Bruce. We are recording this in late December, so we don't want to let anyone, we're trying to pull the wool over anyone's eyes. Our first guest for this 2022 year starter is none other than Jeffrey Sherman, Deputy Chief Investment Officer at DoubleLine Capital, a $137 billion asset management firm located out there on the left coast. We're told we can call Mr. Sherman Jeff. By my count, that gives us two Jeffs, and between the three of us, we have 6 first names. So we're hoping our audience can keep up. Jeff, welcome to the program.
Thanks for having me. And I guess Sherman is also a first name as well, so you can lump me in the mix as well. So I guess that's how we got to 6, right? Yes. All of us have it, right? So
that's right.
I probably go more colloquially by Sherman than anything else, just because Jeff is so common, as you're well aware, Mr. Benjamin.
Yes.
Any relation to General Sherman?
No, but I do have a portrait of him on my wall. I found a nice one, and it's hanging on my wall here in my office. And so it's a shout out to remind me that there is some lineage there somewhere. He's not a handsome dude, so I assume we're related. I assume we're related then.
All right. Well, we'll get to that in another episode. The long and storied history of Jeffrey Sherman. So for starters, we're going to look ahead to the year ahead. Jeff, I know that you have some deep and very insightful thoughts on pretty much all things. I've interviewed you before. It's always a pleasure. I want to kick off with inflation. This is something that has been this kind of burr under the saddle. It's transitory. It's not transitory. It's somewhat transitory.
We've had people on, Jeff, who say, well, like one week we have someone on who says it's transitory, and then the next week or a couple of weeks later, someone will say the exact opposite, right? I mean, we've
even had the fair chairman say, well, I don't think you guys understand the definition of transitory. And it reminds me of that quote from The Princess Bride. Like, I don't think, you're using that word, or you understand the meaning of that word. I'm butchering that quote too, but I don't think that word means what you think it means. I think it's the quote from the movie. But, I think the Fed chairman even said, well, at some point, what does transitory mean? And it's kind of like the, back in old President Clinton day, what is, and, what was it, even Justice Scalia, who is, all about the written word, came out and said, words don't matter. It's kind of, so I think it's, do as I say, not as I said, or not as I do. And so ultimately, I think we've had some ambiguity because, it didn't play out according to the forecast. I think the Fed wanted it to be transitory, but it's hard when we've been talking about it the entire year of 2021. And I think it's going to be a big story for 2022.
Mm-hmm. Well, put some hard numbers on that, though. I mean, where are we right now? Around 6% or something like that at the end of December?
Well, the latest CPI print, and this is what we call headline inflation. So it includes everything in the basket. And so that number was 6.8% year over year. Mm-hmm. So that's the most recent reading is 6.8%. And to put that in context of where that sits, we haven't seen that inflation with a 6 handle, a 6.8% number year over year since, or really in the last 30 plus years. And if you then go out there and take the other side of inflation, and this is stripping out the volatile piece of commodities. And remember, this is where, the Fed and the economists say, well, commodities are too volatile. And really, you don't use any, right, Jeff? Or Bruce, you guys,
Right.
you guys don't use any commodities, right? I'm sitting
Never.
here, it's cold in the rain, I'm having a cup of coffee. Good thing I don't use any of those, right? But if you actually strip out the volatile components, the commodity equation, what you see that one's running out like 4.9%. So we'll call it 5, right? And that number, once you strip out commodities, is actually the highest reading, really going back since the early 80s. So you have a 30-year high in inflation if you take the headline numbers, which is what we all consume. If you strip out the commodity side, which is food and energy only, then it goes down to a 40-year high. So ultimately, there's a reason everyone's talking about inflation, because some people who are in the investment business haven't seen these numbers in their entire lifetime, right? So it is a hot topic. So I think, me telling you about the history is not why you had me on the podcast today. But when we look at the inflation print too, if you look at the year over year number, one thing that's pretty curious about it is that if you look at the number from 12 months ago, the month over month number, so the number that will roll off the data series when you get the next 12-month print or the year over year print, that was 24 basis points was the month over month growth in CPI when you look back 12 months ago. And so what that means, when that number rolls off, we get the new print for the December. And when December of 2021 month over month comes in next month, if that number is, let's say, 40 basis points or so, which is, by the way, where we've been running to about, 0.5% to 70 or 80 basis points per month. If it's more than 40, you're going to see a 7% inflation rate in 2021.
Mm-hmm.
And here we have, the 10-year struggling to make it to 150 in yield today, right? I mean, it kissed 150 this morning as we're recording, and it's been stuck in this range. And so what does that tell you? It tells you that either we are very, very repressed in interest rates, or the inflation is transitory, or another interpretation can be that ultimately the inflation is going to be there. It's going to make the Fed aggressive, and they're going to choke this thing off by hiking rates and slowing growth significantly. So you can have all of those interpretations out there. You can throw in the catalyst of foreign buying. You can talk about pension plans being almost fully funded now, and you can find out that there has been a demand for the treasury market. But ultimately, either treasuries are very grossly overvalued if inflation stays anywhere near these realms, and we think it subsides next year. We don't think that you're going to continue to see a 7% number, and I can get in the details of why that in a minute. But ultimately, the bond market, the rates market looks grossly overpriced, unless that one little piece I said of one of those ors comes to fruition, where ultimately the Fed gets way too aggressive, hikes very quickly, and chokes this entire economy off, which I don't really see as being a base case. And the reason I don't see that is that the Fed has worked so hard with, the QE programs, with, keeping rates where they are, keeping QE in the capacity it had been. And, even the chairman says we need to have a long cycle again. So I think the Fed is flexible. I think Chairman Powell did one of the better jobs that he has done at the press conference back in December, where he's trying to thread the needle. He's trying to get out of bond buying a little bit quicker than he had previously prognosticated about. And, he's trying to say, well, we're not going to hike yet, but look, inflation is out there. And so, I think all of us can agree that, okay, it's one thing for us to say that inflation was transferred. We got it. Let's just call it 7% for 2021. But guess what? Prices aren't going to go down 7% next year. It's very unlikely, let's say, right? And so if that's the case, even if we get this, low inflation going forward, we've already hit a new price reset. So the cost of everything went up. And so I think that's what you're seeing with wages. You're seeing more wage growth in there. But let me pause right there and see if you have any questions about that. Well, I could talk a little bit deeper about how we're thinking about inflation.
Yeah, I wanted, you mentioned Powell a couple of times. I want to ask you about what you see in terms of rates, because this is obviously related. Do you see a rate hike early in 2022? Do you see the 3 that they're talking about? I mean, how do they pull this off? Because this is their defense, right?
Yeah, no, right. And so, I think it's interesting where people say, well, the Fed's telling you 3. And this is where the dot plots have really gotten them in trouble, right? Bernanke hated them after they came out, they've done is try to explain them every press conference since then. And what I mean by that is that the 3 rate hikes you referred to is the median of all of the Fed governors surveyed that go into the statement of economic projections. So we talk about that, but if you look at the dispersion around there, it's quite wide. There's some people with 1. There's a few out there with 2. The bulk of them are at 3 hikes, and there's some that even think there should be more. So we talk about that, but let's instead of say what these governors think, let's say what the bond market thinks. The bond market has roughly 3 hikes priced into 2022. Now, if you look at the way that the curve is priced, exactly what you're asking me, when did the hikes come in? You roughly have, a half a chance of a hike in March. That's when they end the taper. You have a full hike priced in sometime between May and the June meeting. So the bond market's thinking probably the hike happens in May, right? And then you have the second one kind of in the third quarter around September. And then you roughly have one either in December or it actually bleeds into February just because of the calendar in 2023. So the bond market's already there. So what you would see here is that the pricing, and when I say the bond market, that's talking about euro dollar futures. It's talking about roughly the 2-year part of the curve that has this priced in. So when you think about the market, how it's reacting to the Fed, it's already listened to Powell in congressional testimony. It did not reprice based on the FOMC meeting from 2 weeks ago, or is it a week ago now? Time stands still at times, and time flies a lot in this work remote environment, right? Mm-hmm. And so if you look at what the bond market has done, it's already been there. So what happens from here is expectations relative to those numbers. I don't think the Fed hikes as soon as they're done with taper. I think they get the taper out of the way. They sit, they do a pause. So I think the pricing of that first hike, either May or June, makes sense to me. Mm-hmm. From there, I'm not completely sure. And I think why I say that is because I think we get 2 hikes next year. I'm not convinced we get 3, because I think the Fed wants to slow play it. The question becomes, can they slow play it if inflation runs next year, let's say north of 4%? And unfortunately, we're seeing inflation next year have a 4 handle on it.
Yeah, because it seems like inflation is driving the ship right now, right?
It is, because, well, and just think about it. I mean, we did massive monetary stimulus. We did massive fiscal stimulus. And so there is liquidity. We're awash in that. And there's been a change in taste and preferences. And so looking at the components of inflation, and let's just break it down to, it's 2 main components: goods and services. Mm-hmm. So prior to the pandemic, from 2015 on until we had the pandemic, goods inflation was essentially deflationary. It was negative. Sometimes on a year-over-year was at 0 or slightly positive. It went slightly positive when we introduced the tariffs, but in general, it had been deflationary. And you may scratch your head at that and say, well, how's that the case? I went to the store and bought stuff. They didn't see how the prices went down. Some of it's hedonic adjustments and the quality of what you're buying. But effectively, there was no goods inflation. It was all driven by services. And so over the last, let's say prior to the pandemic, the last 5 or 6 years, prior to that, you were seeing service inflation run around 3%. So that was driving the boat, okay? And the biggest driver within services is housing. Mm-hmm. Okay? Housing's not a good, it's a service. People forget that. And so it's a luxury, actually. It's a necessity, but it's a luxury too. So if you look at the service side of it, what you found is that bulk of that was driven by the housing market. So what we call just housing. It can be rent or the shelter component. Okay. And so when you look at the shelter component, there's something called rent and owner's equivalent rent. Those numbers right now are running, if you look at the housing component, it's running in the mid to high 3s. It's about 3.7% is my recollection off the top of my head. Now think about what you've seen out there in the housing data. If If you look at the Case-Shiller indices, look at the FHFA indices, you see that housing's up roughly 20% year over year. You look at the rent data, right? Asking rents, paid rents, you're seeing that those are growing in the high single digits. So there's a disconnect between what the inflation data is measuring in the housing market versus transaction data and what we all actually feel. And there's a reason for that. One is these are surveys asking people the question, what do you think you can rent your house for? And secondly, what you have is there's smoothing effects in there. So they don't just, use this data month over month. They try to smooth out some of the volatility. Why am I belaboring this point? Well, if you think about it, is that the housing market should be at least 2x what you see inside of inflation today. It should be at least 6 or 7%, if not higher. And so what that means is that our service level inflation would be driven primarily by that. So what's going to happen is that because this data series is going to catch up, and it started to already, it's moving in the right direction. It's going to keep pressure on inflation. And so even the transitory goods and things we talk about, durable goods, we saw durable goods orders strong today, though. They were pretty strong. It's probably what's causing a little bit of rate sell-off today. But ultimately, what you're seeing is that those things like autos and what people are complaining about, hotel prices, airline tickets for those that are flying, those are transitory. They will cure themselves at some point in time, but the other side's going to pick up, right? The services component is going to pick up. And now, right now, goods is running at about a 7% year over year rate, and services is running about 3%. So what we're going to get ultimately is there's going to be a handoff from goods to services a little bit. But if goods stay elevated, because again, incomes are higher, savings rates appear to be higher, that people have this ability to consume. And also if you get wages and we keep goods elevated while services come in, there's a potential for inflation to run significantly hotter. And what that does is that kind of begets the idea of inflation, because inflation is a lot of times set with expectations. So it becomes this self-fulfilling prophecy, is that I think I'm going to get inflation. I see inflation, so I go out and spend to try to get in front of it, especially when my savings account earns 0, right? Or maybe a basis point if you're lucky. So ultimately, it can feed into itself. Now, we don't think there's that price spiral today. We just think this is really this transition because the services side needs to catch up, specifically due to housing. And so we think that continues to keep pressure on inflation next year. So what that means is we have something north of 4% in CPI. And what that tells you is that the bond market offers you a negative real yield, right? And so when you look at it, the Fed probably should be hiking in some capacity. I just don't think that they can be aggressive because they know that they have risk of kind of derailing the risk rally and everything we've seen for a while. So that's a long way of getting into it to say, I think the Fed has the potential to be a little more patient than what you see, but I don't think we're going back to old school 2% inflation for the next couple of years. And that's all going to depend upon the wage side of the equation. It's going to depend on the growth of the economy as well. But I definitely think that we're going to see above 3 for the next couple of years.
Okay. Hey, Jeff, I want to get one more thing from you before we kind of bring Bruce Kelly into this conversation. But you mentioned bonds. Obviously, bonds are a big part of this whole equation. DoubleLine is in many ways known for its bond portfolio management. What do you do about bonds in this environment? I mean, whether against the backdrop of everything you just talked about or kind of even bigger picture. I mean, a lot of people, and I've written stories about this, financial advisors, which is our audience here, they are having a hard time justifying bonds in portfolios right now.
Right. No, and look, I started off by talking about inflation and real yields, right? And so if you actually go back and look at it and you take the Fed funds rate, and I'll get into your bond question, but if you take the Fed funds rate and subtract inflation, you have the most negative real yield of interest rate policy ever. At least in the time frame that we have data for. So since the existence of the Fed, that's a lot, right? That's a pretty dang accommodative policy, right? But in general, what you're asking is, why do you own these things at all? They're not going to protect my purchasing power. Well, there is one thing that bonds can help you do. They can help dampen volatility. It can also create volatility, as we've seen, right? You know, if we had this repricing of the bond market, it can create it. But the drawdown in bonds tends to be less than that of risk assets, right? So it does give you a volatility dampener. And I think that still holds. Now, can they be correlated positively? Absolutely. We had in the 90s that bonds and stocks were positively correlated. That is, they went up together, they went down together, right? And so I think that if you start to see the positive correlation of bonds, it's both to the downside, but it's more from the standpoint of not fearing the bonds for what they do. They're there to provide kind of that stability in the overall portfolio. Now, there's another way to think about it. If you want to think about, okay, I need to generate a real yield, what I would say is that, okay, you can do, when I say a real yield, I mean a positive real yield. So I want to at least maintain my purchasing power. Well, if you go with my forecast where at DoubleLine, we're thinking that, it's probably a 4-handle CPI next year. Where can I get that type of yield? There's not a lot of place in the market. You've got to go into the lower qualities of the below investment grade corporate bond market. You can go into kind of the below investment grade parts of the structured products market. You can go to emerging markets, the below investment grade. Notice what I said, everything there, below investment grade. Mm-hmm. So there's nothing wrong with investing in below investment grade assets, but they're going to be riskier and they're going to be they're going to have higher correlation to other risk assets such as equities. So if someone's out there that's really thinking about the bond portfolio and wants to load up on high yield or wants to buy a lot of bank loans, which that's been kind of our preferred trade for the year of loans versus high yield. We still have that view for next year. We like the CLO market for that reason as well. Some floating rate because there is going to be uncertainty around the interest rate environment. So that floating rate we think has upside too, just because the coupons can get reset. But if you look at those assets, they're going to be more positively correlated to the equity market. And if that's the case, then you shouldn't be using this for your bond bucket. It's more of the chicken's way of playing the equity market, right? So if you're gonna have high allocations, they shouldn't be funded by that kind of Barclays Ag or Bloomberg Ag, I think it is now, or your treasury position. It should be thought of as part of your risk bucket, and so you can just scale it accordingly from that side. So I think that it's so that's one way. That's another way of viewing it. I think more importantly too, if you want to own diversification, you want to have that ballast on the former side I was talking about, and more of a stability. And you want to own credit, you need to own it everywhere. You want some investment grade, you want some below investment grade, you want to own some real estate. You want to own things that are like asset backs that have this correlation to real assets. You want to own emerging market debt. You want to own some non-US debt to play against the dollar. So I think that diversified basket of credit is a better play. And look, if something, you get some hiccups in risk markets, you have that ability to rebalance away from some of these assets. So as I look to 2022, we're not out there delving down in the lowest credit qualities, but we are running credit on a balance of credit and rates. We have more tilts towards credit than rates. We're still underweight duration. We think that that's the right call. We do think the front end of the curve continues to reprice as there's some Fed policy. And so I think what you're going to see is more of a parallel shift in the curve, and maybe a potential steepening because some of the back end sells off a little bit more. But I think we're going to have this gradual repricing upward of rates. So what that means is be somewhat cautious in the duration. You've got to be active in this stuff. You got to be moving it around. And that's what we're trying to do and trying to plan for next year.
Bruce Kelly, you have anything for Jeff?
Yeah, Jeff, great stuff. Thanks for coming on the show. Jeff, Benjamin kind of slipped in what I was going to ask you about, the strategy around this. If you're a financial advisor right now, I just wanted to follow up with you on that notion of bank loans.
Yes.
And how do you, if you're a financial advisor, and some guys, take a packaged approach, they work with InvestNet and they just kind of use what InvestNet manages. When
you say InvestNet, are you talking about the kind of model portfolio?
Yeah, model portfolio or a packaged portfolio or turnkey asset management.
Yeah, TAMPs. Yes, TAMPs, great acronym.
But then but there's others who other advisors actively manage, right? And if you're looking at bank loans, what are some of the things you really got to be cautious of? Because I've written plenty of stories about bank loans, kind of blowing up on people.
Yeah, I mean,
over
bank
time?
loans.
What's the
Yeah.
cautious? How do you kick the tires on something like that?
Yeah, so bank loans are kind of this weird beast that they have some inherent issues with the settlement process. And so because they're not traditional, security offerings, they take longer to settle. And so typically you'd see an advisor, you wouldn't be buying loans directly, right? It's like, as a financial advisor, would you go out and make
use
a loan?
a fund, right? You go to a fund.
You're going to use a fund, right? And because you're not going to go out and make a loan to a guy named Jeff Benjamin, right? That's not what advisors do. I mean, he may be a AAA quality asset, but it's hard. You need someone, it needs to be DTC clear. There's a lot of stuff. So people buy funds. Now, the funds, there's two approaches. There's the index, like the ETF, and then there's the active managed approach. And so I would err on the side of, look, if you don't know what you're doing, just buy the index, right? If you want the exposure, it's the most liquid names, which means it's a little inefficient, right? It trades the highest name. So the more debt you have, the bigger the weight inside of that. So there's some kind of inherent issues with that from a quality standpoint, but it's the most liquid stuff.
Right.
But that also means when there's a run, it's the most liquid, it gets hit a little bit harder.
Right.
So as long as you understand what you're using it for, that's fine. Now, if you want to get an edge, there are actively managed products out there. And those actively managed products, you'll see, have yield pickup, right? And it's not just because they're dumpster diving, it's because they're more calculated and they trade around the index. And so we think the index in the bank loan market is extremely inefficient. However, it's better than not having exposure. So I think, from the standpoint of the diligence, I think you got to understand the manager, their ability to traffic in the space. And there's a lot of good names out there that could do that.
And what can you capture if you're looking for a little bit of yield? Like, what is the spread over
100? 100 would be active versus an active fund versus a passive fund is roughly 100 basis points today.
Right. Okay.
Yeah. So I mean, and in this world, that matters a lot.
Yeah, it sure does. Right.
Yeah. I mean, that you got to get out to almost the 5-year part of the curve to get that, right?
Yeah, that's fascinating stuff.
Hey, Jeff, speaking of a lot of these, you're talking funds and portfolio management. I know you're acutely aware of what's happening in the ETF space as we wrap up 2021, closing in on a $1 trillion in net inflows. Obviously, it's a record year by twice, I think, or by double.
Yeah.
What's your position? And DoubleLine is thought of as an active management shop. I mean, are you guys feel like the category is kind of losing some steam, if not against the ropes?
Well, you just said that it doubled in inflows, so it doesn't sound like it's losing steam to me.
No, I'm talking about active management.
Oh,
ETF
active management. Oh,
yeah.
Okay. Well, if you notice too, and you read the headlines, that there's a new wave of actively managed ETFs that have been launched and are being launched too. And I think the ETF wrapper is becoming more widely accepted, and you're going to see much more in the active space there. So I think there is this natural transition out there where you're going to see more and more active ETFs, because I mean, look, I'm biased. I work in the active business. I don't believe in completely efficient markets, or I wouldn't be on the active side of the business. And so I just think it's a wrapper, and I think that advisors like it. They like intraday liquidity. There are some challenges with the active models, but it works. So I think, in general, that I think it's getting more adoption, the wrapper, and therefore I think that you're going to start to see more prevalence of active management within there. And so you've seen some of the major players in the mutual fund business get into the active ETF space. Some have done conversions, and some are just doing pure launches, right? So I don't think active is dead. I just think you need some differentiation out there. And obviously fixed income is very well suited for active management, and ultimately advisors like active management within the fixed income space. So I expect to see significant more innovation there. And as the rules have gotten much easier to get on, to launch an ETF, to be out there and really run more strategies, because there's been a very tight guardrails on the active side, especially in fixed income, and they're getting broadened and broadened out as there's more acceptance. So I do think you're going to see more prevalence there of fixed income, active fixed income, in the next 3 to 5 years.
Well, yeah, a good point that you made there, that active fixed income is an area of of continued growth and net flows. Of the I think 330 billion in net outflows from mutual funds, the active mutual funds this year, it was all on the equity side. So Jeff, what do you think about what's happening in the ESG space right now? This is an area that's been white hot, flows going into it at record numbers. I don't know where DoubleLine is on that, but I'd like to know what your thoughts are on the category.
Yeah, I mean, I think it's, there's always good intentions with this stuff. And then there's the marketing machine, right? And so what I mean by that is, do you want to have a better environment? Yes. Do you want to have a better social structure? Yes. Do you want to invest in companies that have strong governance? Yes. So I check the box on that acronym. Everybody wants something like that. However, there is some, what they call greenwashing in the space, where because it's been a white hot segment of the market, and if you just slap the name on it, you can get flows. There's some kind of, I won't call them bad actors, but people who are a little more disingenuous. The other problem we have with ESG as an investment business is that there's no standardization, right? There's people who approach ESG from the inclusive standpoint. We will only invest in companies that do E, S, and G. And there's people who are exclusionary that say, well, we kick them out if they don't do the screening. And then you have the middle where it's like, well, we want the best of the polluters that are trying to go in the right direction. So there's a lot of uncertainty around it and what it really means. And so it's kind of like, Jeff, you and I talked a few years ago, like I think you said it was 7 years ago when we were chatting earlier about smart beta. And
right.
It's another ubiquitous phrase, smart beta. But what does it mean? There are some definitions out there. It's things that are not market cap weighted. They tend to be systematic or rules based. But just because I have a smart beta fund, you don't know what that is. I could be doing smart beta in small cap equity. I could be doing it in commodities. I could be doing it in fixed income, right? Mm-hmm. So it's the same with ESG. It has this ubiquity that everybody knows what it is, but then you don't know what it is under the surface. So look, at the end of the day, we want to do what investors are looking for. So we've been working on our policies here. We've formulated a policy, but we don't have an ESG product. And we don't have a product out there because one, we just don't want to have this idea that people only buying it for that. We'd rather incorporate it throughout the whole process. And so because we span, many different markets, it's been more challenging for us to get it into the investment process. So we've been working on that in 21. We're trying to, get to where we can have some consistency, because how you trade emerging market corporates versus trading, U.S. corporates versus how does one treat a residential mortgage-backed security? What do you do with loans, CLOs? Do you look at the underlying? Is it the manager too? So what we've been trying to do in some of our working groups is figure out a consistent way to be intellectually honest about what we're doing and have a system that tracks it. So we have it into our process, but the way we think about it to date thus far, is a very high level is, does ESG pose a massive risk to this company? That is, do they have these certain risks out there? And if so, are you being compensated for it? Because at the end of the day, if we all pile into ESG, it will strip capital away from the ones who are not friendly. But also what that means, if you're stripping capital, there's a new premium. So again, I'm not here to say you should trade against ESG. I'm saying, what are you hiring us as a manager to do? Are you hiring us to change the world? And if so, well, we're trying to incorporate that. We all want to breathe well. We want to make sure that our trees are around. We want to have water. I live in Southern California, by the way, right? So, all these things, they resonate with us, but is that our mandate in the IMA? So we still have these kind of interest. We're still trying to digest all of what it means. And it's a very wishy-washy topic. And so that's not a popular opinion to have. And, it's something that if we do it, we want to do it right. And so what we've been working on is getting it into the process, but it being more of a risk factor than necessarily like, oh my gosh, it's the greatest thing since sliced bread.
Okay, well, And just an FYI, I wrote about that bad ETF yesterday, and I'd like to think that you read that on investmentnews.com.
That's probably where I grabbed it, Jeff. So,
Okay.
I always go there first thing in the morning. So it likely is that. But I mean, and I sent it to my team members, and they were like, "Oh, it's just such a great ticker," right? And so
yeah,
I think 95% of marketing in the ETF world sometimes comes down to the ticker.
Well, my biggest response was, I can't believe that ticker was still available.
I know. And then I had that Michael Jackson song in my head for the next hour.
Well, the last thing I wanted to ask you about, and then we'll see if Bruce has anything else, is I was going to ask you about the Build Back Better thing, but when this podcast drops on January 3rd, that might be a totally different news story. So I want you to grade Joe Biden and the Biden administration in the first mostly a full year.
Well, it's not an A and it's not an F, and so it's probably somewhere in the middle. And so I think that there's well-heeled intentions here with the administration, but I think just you can't solve everything by just throwing money at it all the time. Mm-hmm. And so a lot of folks are worried about 22, that if we don't have more fiscal stimulus, that the economy can't support itself. And I have a lot of sympathy to that argument. Because if you look at what we ended up doing in fiscal stimulus and increasing the deficit, it was greater than the amount of GDP that we've actually received from it. So that means the money multiplier is less than 1, and without the stimulus, we wouldn't have grown. But the question is, are we in a decent place to grow without that stimulus? So there's something that people look at, like macroeconomists and things, that's called the credit impulse. And when I talk about a credit impulse, it's talking about the change in the expansion of credit. And if you look at the impulse from the fiscal stimuli that were out there, the bulk of that has already happened, right? So the impulse is there. We've already seen the base effects roll off. Now, the one thing that hasn't rolled off completely were the extraordinary unemployment benefits. But the CARES Act has effectively rolled off, right? What you saw in all of the various programs to get things back up and running, like the PPP and all of that we did to keep the economy going after we shut it down, those effects have already rolled off on a year-over-year basis. So we actually have a negative drag from it already. And that's what I think that some people miss. So if you tack on another program that, let's just say, is somewhat effective, because we know with every government program, it gets about half the benefit and takes twice the cost, right? So you get a fourth of what you were promised, right? And so, if we can get something done, and I think with Manchin, the headlines when we started this week were that, the deal was dead over the weekend, that nothing was going to happen. Then kind of the truth came out a little bit more that, it's on hold. Manchin wants the number down about $250 billion. It's nothing amongst friends, right? So I still think there's the potential to do it, but the longer the wait, the more dangerous it is, because you get closer to midterms.
Right.
So don't forget, it's a political game. So I think the administration's done an okay job. I don't think there's anything great to write home about at this point. But ultimately, just throwing money, trillions after trillions, isn't going to get it done either. So we have an infrastructure package. Let's see how some of that money gets spent. But I still think the more important aspect is the private market. So we had talked about real yields. If you are a corporation today and you can go borrow in the corporate bond market, heck, you can borrow in the low market, you borrow in the short end of the curve. Let's say you're borrowing at 5 years and inflation runs at 3% over 5 years. Your cost of capital is less than the rate of inflation, right? So that means that it's very accretive for companies to go out and borrow money. And guess what they can do with that money? You could pay back your shareholders, right? You can do stock buybacks, you can give out dividends. You can also acquire people, right? You can do M&A. You can do CapEx. We've seen a big wave of CapEx this year in the second half of this year that we hadn't seen in a long period of time as well. So because of that negative real yield environment, there are other things that are accretive outside the fiscal authority. So I think the thing is it has to play nice with what's going on at the Fed. And the political climate is now, when you see, members of Congress talk, they're saying, well, it's because we gave out free money. That's why we have inflation. And look, we gave out a lot of money, but we also shut down the economy. So I'm challenged to know what the administration can do, any administration, because it's just rife with conflict. And so I think that I think the Democrats have a very tough time in midterms, just because in general, I think this is a world that's anybody but incumbent. And so we're just going to keep rotating the parties in power because we're all dissatisfied with everything going on. So it's probably a little multi-layered than what you were looking for there. But, we do need some targeted fiscal concepts. But at the end of the day, what's going to drive the economy is people working. And we know we have 5 million fewer people working. A lot of that, as we've done work on the demographics and looking through it, are just early retirements. It's that older age cohort I don't think comes back. So we've seen an increase in productivity, right? Because we have fewer workers and we have more GDP per capita for working people, therefore higher productivity. But the challenge we have, if you just look at what came out in the census data, we had the lowest birth rates we've had on record, right? In terms of percentage of growth. I think it was like, we grew at like 10 basis points year over year in terms of population. So that's going to be a little inherent drag. But ultimately, the private sector is what drives the economy, right? And that's why everybody wants to say, let the private sector do what it needs to do, because we're the job creators, right? We're the ones that pay the wages, and we try to deploy capital in the most efficient way where we think it's going to work out the best. And so the private sector, I think, is going to continue to drive and innovate here. And so hopefully we can do that transference. We had the government safety net in 2020. It extended out some more in 21. And we really don't need the safety net right now. Why not let's just save it? It's very apropos. It is a rainy day here in Los Angeles, so save it for a rainy day.
Really good stuff. Bruce, anything else for Mr. Sherman?
No, all good.
Well, hey, Jeff, really good stuff. Thanks for taking the time on this rainy day in December for you. It's sunny where I am, and it's always sunny where Bruce is. So thank you very much for taking the time. I'm sure we're going to try and get you on here again to pick your brain on more of these.
We'll come back and talk about inflation and see what happens when.
Let's see, and you can tell me how wrong we were one way or the other. Either it's going to be a lot
when the Fed
higher than we
hikes
think,
or
or maybe a lot lower than we think. So we're going to have to see. But as always, Jeff and Bruce, it's a pleasure chatting with the two of you, and keep up the good work you guys are doing at Investment News.
Thank you, sir.
Thank you.
The audio presentation represents DoubleLine's intellectual property. No portion of this presentation may be published, reproduced, transmitted, or rebroadcast in any media in any form without the express written permission of DoubleLine. DoubleLine has no obligation to provide any updates or changes. To receive permission from DoubleLine, please contact media@doubleline.com. Neither DoubleLine nor any of its affiliates makes any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast. Liability, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. DoubleLine is not providing any financial, economic, legal, accounting, or tax advice in this podcast. The receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any DoubleLine entity or individual to that listener, nor to constitute such person a client of any DoubleLine entity. The portfolio risk management process includes an effort to monitor and manage risk, but does not imply low risk.